All right, so a lot of you should know Odd Stats on Twitter. If you don't know him, you should follow him. He's always got good quotations and stuff, good tweets, I should say. And it's funny, he made a tweet about Jim Cramer yesterday that Jim Cramer responded to. It says, "Man who literally dials up rhetoric for a living asks for rhetoric to be dialed back." And then Jim Cramer responds, "Chief, you caught a 1,000-point rally if you listen to me, so perhaps you should rethink your decimal analysis." And indeed, I actually mentioned in my last show that Jim Cramer was a calming influence on the market, and when everything was going down, he was saying, it's not a big deal, Apple hasn't sold off that much, et cetera, et cetera. So I will give Jim Cramer credit in this limited situation as being right. Anyways, there was another Odd Stats quote which I found, which I want to. There was another tweet of his that I wanted to refer to, which is why I had brought him up in the first place. And let's see if we can find it. I believe this is it right here. And meanwhile, our P&L, if you're following the P&L thing, I can show that to you right now. Up a couple $100 from last time. We'll take it. The position hasn't changed at all. It's kind of a add water and stir position at the moment. And just to refresh your memory on what position we have, we are long the September 30, 27.5 put spread in UVXY. UVXY currently up $1.77 on the day, trading 32.58. Now, if we take a look at UVXY, and my display is all messed up, so I will quickly fix that as I speak to you. All right, that's a little bit better. If we take a look at UVXY, we can see that it has rallied a bit today, and this mostly due to the market selling off a little bit. But overall, not too bad, the market right now. We are off the lows. If we take a look at the E-mini chart, and I get out of the way here, you can see we're well off the lows and of a couple days ago. And I think this is just kind of like we just need a little time for this to kind of come back a little bit. So I'm just being patient. No trades today. No trades yesterday. And after a flurry of stuff, you're going to see this is the last couple sessions as we've sort of come off that down move. And what we talked about with the term structure did happen. We went back into contango yesterday. The VIX popped back up today, though, and now the VIX is we're slightly in backwardation again, but things overall just very flat in the VIX land right now. If we pull up, here's the term structure, and very flat. You know, they put some functionality on this a few months ago where you can do wide or flat, but it should really be like that right now because the term structure is very flat. The spot price is lower, however, than the top two futures, and I wouldn't be surprised if we go back into a slight contango. But overall, term structure not doing a whole lot. Now let me continue looking to try to find this tweet from Odd Stats because I thought it was significant. Several people have been kind of remarking that it was a huge down move in the VIX like 2 days ago, and we were coming off of highs, and so but VIX went from 24 down through 18 in like two or three sessions, which is a pretty big move. So let's see if we can find Odd Stats here. Odd Stats. There we go. Tweets. All right. This is the one I was looking at from this guy. And it says, you probably noticed that the VIX dropped from over 24 to under 18 within 3 trading sessions, something that honestly hasn't happened that often since the VIX began. You probably think like I did that this was extremely bullish short term. It's not, neutral at best. And it shows this chart of each time, and this guy comes up with these charts a lot. It's something that also like Dynamic Vol does a lot. And it shows every time the VIX has dropped from 24 to under 18 within 3 days, and it's showing all those times, or a lot of those times, it's meant a lower market moving forward in the future. So who knows if that's meaningful or not, but that is the deal as far as odd stats is talking. And in my opinion, we had a spike, and I'm still short because I have a feeling that we're just going to slowly settle down. If we take a look at the VIX chart right now, we can see the spike and then it coming in, and yeah, it's got a little blurb on the way down, but I think we will. It's likely that we head back down to like 16 or something. But we're kind of getting through earnings period right now, and we'll have to see what happens. There's obviously turmoil everywhere in the world, but that's always the case. It's a lot better for us. One thing I wanted to talk about also is that UVXY. If you looked at the P&L yesterday, when this got down to like 31, my P&L was like way up. But what they do with UVXY, when UVXY goes lower, like let's say UVXY goes through 30 in the next day or two, UVXY acts the complete opposite of other stocks. So when UVXY goes lower, they take volatility in. So if you look at the option volatility in UVXY, if we were to go to our products here and we look at the months, we've looked at these before. Just to my right of my head are the months and the volatilities per month, and we see like 107, 138, 130, 119. As we come off of a spike, these volatilities will come in. So as UVXY moves lower, if UVXY were to get down to like 26, 25, these volatility numbers go down more and more and more. And it's also a function of us moving down the skew. So if we look at UVXY options, the calls, out of the money calls, have a much lower volatility. Out of the money calls have a higher volatility, and out of the money puts have a lower volatility, because the risk, remember with a stock, the risk of a big move in a stock is generally for the stock to crash. And so out of the money puts will be skewed higher. After the 87 crash, they started putting a skew in all options. And ever since then, generally in a stock, the out of the money puts have a higher skew. If we were to pull up, let's say Apple, if I can spell it, and I switch to a screen that shows implied volatility, you're going to see, let's see, implied volatility. You're going to see this line here. I'm in the way again, sorry. This line here, it's going to be it's going to say strike, bid X, ask X, implied volatility. Okay, this line, implied volatility here. And I can even blow it up so you can see it better if that helps. It goes up as you cruise down through the put strike. So this is if you're on a phone or something, you can see it better. As we go down, as we get farther out of the money puts, the skew gets higher. It's 30, 30, 40, 50, 60, 70, 80, 90, 70, right? Out of the money calls, in a regular stock, it's a very common strategy for people to do buy rights, to sell calls against their long stock position. Most of like mom and pop public are long Apple, and some of them have been told a strategy, oh, well, you're long Apple, why not sell some of the 230 calls? That way you make income if stock stays where it is. If stock goes all up to 230, and your calls get called away, you'll be happy anyways because you made that profit up to 230. If stock doesn't get to 230, you're going to collect that extra income from selling calls against your long stock. So from supply and demand issues, the calls get, the skew gets pushed down. And so out of the money calls, when we look at that line on this, which is the first line here as we look down the screen, is the calls. And you can see as you move up, the volatility goes down. Now, once you get to the 1 penny calls, it's going to show some weird outlier figures. But calls that actually have any premium to them, you're going to see as the strikes go higher, the volatility goes down. So at the money in October, we're looking at 27 vol, 26, 25, 24, etc. And the out of the money puts goes up. Okay, so then if we look at UVXY, however, it's the opposite. Out of the money calls in UVXY, you can see them here. 118, 119, 120, 126, 128, etc. The puts, it's the opposite in UVXY. Out of the money puts are cheaper. So as we look down, at the money 118, the 28 puts 113, 23 puts 108, 20 puts 102, etc. So that's what I mean when I say as we move down the skew, as we get to these strikes that have a lower volatility associated with them, the overall volatility of UVXY is also brought in. They actually will go into the quote, when nothing's going on, they'll actually go and they'll adjust their prices and move volatility down in the options. Once we pop and UVXY spikes, they'll move volatility up. Another way of thinking about why market makers pop volatility when UVXY goes up is because, think about it, you and I, when volatility goes up in UVXY, and when UVXY spikes, a lot of people are going to say, I'll buy some puts up here and I'll ride them down, right? So they know that there's going to be put buyers when UVXY goes up high, so they raise the prices because, as a market maker, when you make a market, you generally would prefer that the customers take one side of the trade or the other. So you're not necessarily always going to make a market that straddles fair value. So if you consider fair value in a UVXY put to be $3, you're not necessarily going to make a market 275 bid at 325. If you think that there's definitely going to be buyers, you might make a market where when fair value is 3, you might make a market 3 bid at 350 and just kind of hope that that you're right and people come in and pay the offer on those puts, then you're getting more edge. If people come and actually hit your bid and sell them to you at fair value, you could take them down very rapidly. But in general, at least when if I was allowed to work as a market maker and I was the only market maker there, I would lean the markets the way that I think customer paper is going. So you think when UVXY is spiking, the assumption is people are going to come for puts. So those puts get jacked way up. Then when UVXY goes back down, the assumption is the people that bought those puts from you are going to come back to sell them back out to you. So you take volatility back down. So, and you could kind of see that even though our position here is put spreads, it still kind of acts like puts because the put spreads are pretty far out of the money. So as UVXY went lower, all of a sudden the P&L, the profitability in the P&L went from up $2,000 on the day to up only $1,000 on the day because they took volatility in. And part of that is assumption that that people are going to come and sell those puts back that they bought when UVXY was spiked. Now, let's talk about the position again for a second before we move on to more interesting things. The issue with trading UVXY, and we've talked about this before, a major issue with trading UVXY is liquidity concerns, and it has varying liquidity. Sometimes it's very liquid. Other times it's just tough to get anything done, and you're going to be held hostage by your position. So, well, that's weird. Why did I get smaller? So, we have to keep that in mind, and I'm going to show you right now what I mean by liquidity problems. Hello. let's see. I'm just trying to get the screen straightened out. Let's look at the open interest and the strikes of the puts that we put on, and you're going to see that it doesn't look good. Sorry, I'm just trying to clean up some. I've got so many different screens in this OBS that I'm just trying to clear it out a little bit. All right. I'm just trying to make this a little bit bigger. All right, so there we go. So if we look at the open interest once again, we have this 6 September puts on, right? If we look at the open interest, I'm going to go to the top of my screen here. I'm always flipping through the layouts in the screen here. So if we go to volume open interest, you're going to see there's no volume in this week, the 6 September week, especially in the puts. You're going to see, all right, they traded 15 of the 31 puts today, 4 of the 30 puts, and 2 of the 28 puts, and 10 of the 25 puts. So there's not a lot of liquidity in this month. In fact, the trade of us putting on the spread was probably one of the bigger trades of that day. So, however, we know that as this rolls forward and this gets closer to the front week, once this is the front week, there'll be plenty of liquidity. Look at the front week here, and you see 9 August front week, we've got 1,000 of each of these strikes trading, 1,000, 2,000, 1,800. You know, there's several thousand of each at the money strike or near to at the money strike trading. So there's plenty of liquidity once we get closer to that being the front week. But right now, there's not a whole lot of liquidity in September. So the markets become wide. We have to be careful when we're trading in and out of stuff here. If you know what your fair value is, then it's fine. You can make bids and offers that make sense, but you're not necessarily going to get filled, and it can be a little bit tight. Right now, just hanging on to this position. You know, I go through periods of activity and inactivity, and right now we are short 300 deltas in UVXY, and we're hanging out. We're coming. I still see it as we're coming off that spike. As we speak now, the VIX spot has passed through the first 2 months and the third month, and we probably will organize back into some sort of contango by the end of the day here, but very, very flat. The term structure has remained flat, and that is just a function to me of we haven't quite normalized yet. You know, when in the middle of the spike, we were in a situation where a spot was like $2-3 above the futures. And so it took one day of the VIX being down like 3 and UVXY not moving all that much for a spot to come back towards the futures. And then it took another day of spot going lower and the futures kind of getting back arranged to get us to where the spot is equal to the price of the futures. Now it's going to take probably another couple days for spot to go way down below the futures. Now it was nicely down below the futures at the end of the day yesterday, but it didn't quite stick there. And so we're just going to have to hang out and be patient here. Patience is definitely a virtue in trading, and it can definitely be difficult to be patient. And this happens sometimes. My UVXY seems to have fallen off my watch list here. UVXY. Let's put it back up there. So we were up like $2. Now we're up like $1 on the day. And we'll see if this market can, somehow rally back so that UVXY is unchanged on the day. That would be a nice comeback for UVXY today. But as we look at the 5-day chart, we have to be happy with what we see with this position because we see it coming off the spike and slowly moving lower. We have another 27 days for it to make it down to that 27 level. And, it's kind of on course right now. I mean, you can't expect this to move straight down every day. But, we've had a few down days in a row and we're kind of on course. So happy with the position right here. And that's where we stand. Now let's take a brief look here. Anything from the chat? Chat is quiet today. Hey, hello, chat. I sending you out some love there. Yeah, so that's where we stand, UVXY. In my measured opinion, I feel like we are going to continue to come off of this spike. But, you know, we have to just wait and see what the market does. But if the market continues to recover, then obviously we will move lower. I'd like to see the VIX get down to like 16. And we'll see what we'll do from there. Now, the question I want to pose to the audience is, all right, so here's this position we have. We're long this put spread in UVXY, the SEP 30 27.5 put spread. Now, how are we going to get out of this? Thank you, PR Product. Hello, successful trader, otherwise known as Applied Way. What are we going to do to get out of this position? Let's say that everything works out the way we want it to, and this rolls down to 28. Let's say UVXY is 28 in like next Wednesday. What are we going to do? Should we just sell out this put spread? Right now, the put spread that we are long is worth, let's see what it's worth. I could just look at the bottom of the screen, but we'll do it this way. If we were to buy this put and sell this one, it has the midpoint at $1.55. We paid about 89 cents for this. The offer is 186, and let's see what the bid is if we were to just hit the bid. If we were to hit the bid, why does that not make sense? Yeah, I guess midpoint is 186 now, and the bid's 155. So the question is, if this gets to like 28, do we just sell out this put spread for our profit? Do we try to wait? Remember, if we wait until expiration, this put spread is worth what? Well, how many points are between? Here we've got 2.5 points, right? 30, 29, 28, 27. So 2.5 points. So it's worth 2.5 times 32, right? So 2.5 times 32 equals $8,000. So if we just let this go out worthless, it would be worth $8,000. However, you know, when it gets closer to this date, let's say it's a couple weeks from now and it's around 27, we might just want to lock in some of this. So we might want to take some of it off. But the other idea I have with this put spread is to actually turn it into a condor. And you've seen me do this before. So if this were to roll down to, let's say we got extremely lucky and UVXY went to 26. Well, we could go ahead and sell. There's $2.50 in this put spread. So we have $2.50 worth of buying power that we can use below here that won't cost us any more buying power. So we can sell a $2.50 put spread up to 32 times below strike here. And then if things end up expiring in between the 27.5 strike and the one we sell, we make even more than $8,000, turning that into a condor. We would make $8,000 plus whatever we sell the other legs of the condor for. So, for example, right now, if we were to sell the 26 put and buy the 23.5 put, that would be an example of using that buying power that we have to the downside. So if we were to sell this to 2.5 point spread 32 times, it would essentially, we would be taking $1,600 off the table right now. And if this ultimately ended up on expiration between those prices, between 27.5 and 26, we would be collecting the $8,000 plus another $1,600. So almost $10,000, which would be pretty good considering this was marked at $900 a couple days ago. Anyway, the thing is, though, if we put this spread on now, then it's going to change our delta a lot. And if we were to put it on now for just 50 cents, you know, what if we take this trade in isolation? Well, we're selling a $2.50 put spread for 50 cents. So that could seriously blow up in our faces if this, what if we're just really right and this thing goes to 27 the next week and then it gets down to 24? Well, we don't want to give up all of our profitability by selling some cheap put spread against it. However, if volatility completely collapses and goes back to 11 in the next 2 weeks, then we would probably consider selling downside. I mean, if we could sell if this thing goes to 23, we would definitely consider selling like the 21, 19, or 18.5 put spread, something like that. But for now, we'll just leave it on. But my question to you is, would you prefer, if let's say UVXY, everything's great, and in 2 weeks this UVXY goes to 25, would you prefer just to take the trade off and put the money in your pocket, or would you like to sell some downside against it and maybe unlock some of that buying power to the downside that we've created by buying this put spread? What if we only sold 5 put spreads against it? Would you consider that? Just something to think about. All right, so I'm glad, Applied Way, that you've been successful recently in some of your trades. I feel some sort of responsibility for introducing you to those calendar spreads, and the fact that you kind of got run over in square. That's a bummer. Yeah, they are hit or miss, and it's very hard to judge those calendar spreads. I was looking at that one in TTD. Let's see what happened with TTD. I'm not sure if earnings have come out yet or not in TTD, but it looks like they have come out, and it looks like that would have been a good one, huh? The trade we were looking at was we were looking at doing a calendar in TTD, and we were looking at buying the September 260 put, 265 call. I think we were looking at buying this one, the 265 call, and selling the front week 265 call. And now, watch, we're going to look at this. It's going to be a huge winner, of course, because we didn't do it. But we'll look at it anyway. August 265 call. Yeah, so we were looking at paying $9 for the spread. Now it's worth $14, the spread. So this would have been a huge winner, of course, this calendar spread, but we didn't do it. The other one we were looking at is just the 2 weeks, paying $2 for the August 9/16 265 call spread. So let's look at that one. 265, and then the week before, 265. So we were looking to pay $2 for that one. That one went out at $3.35. So that would have been a winner as well. Of course, the ones you don't do are winners, right? That just makes perfect sense. But the reason, one of the reasons that these were winners, of course, is that these are higher premium issues. We're not dealing with like $1 versus $2. We're dealing with like, $25 versus $30 when we look at these spreads. So what was the trade in this one? Well, the front week was really jacked up ahead of earnings. And why did this trade work? Well, one of the reasons it worked is we didn't get a huge move on earnings here. Look, earnings came out. Stock was like 273. Right now, stock's 277. So, that's the earnings didn't get a huge move. So that is why that trade was successful. And it would have been nice. Yeah, it would have been nice to spend $9 and have it be worth 14. That's a nice one. But it's pretty scary spending $900 a spread, because you're like, well, I don't really know what's going to happen, Let's see. That's a good way to skirt the PT rule. I need to work on taking profit faster. I've unlocked buying power only to become over-leveraged. Yeah, well, the other thing with putting on, when we go back to our UVXY example of, we've got this put spread on. If we were to sell another put spread against it, the problem is that now, unless you've got to leave that money that you collected from putting that put spread on in your account, because otherwise, if you go and use that buying power for something else, if you want to take this trade-off, you've got to take both sides of the trade-off at once, because you take one side off, it doesn't relieve your expense requirements, right? Because each side of the trade requires that capital. That's why they balance each other out. So you put on that second part of that spread. It's best to do that kind of trade if you're just going to leave it to expiration and ride it out. If you're trying to, otherwise you need to keep that money free in your account for what you sold the spread for, so that, you know, you could sell this like 26, 23 and a half spread, and then this goes up and you trade around it. So you sell the spread, UVXY spikes again, you buy the spread back in to get short at the top again. So you can trade around it. However, you know, with commissions being, you know, a factor, I don't really want to trade like $2 wide spreads a whole lot, because each time you do that, you know, it's a dollar a contract eating away at you. So as we speak, UVXY coming in still. Remember, our strikes are the 30 and the 27. So it would be great if we could get UVXY to actual strike. It was a little scary putting this trade on when UVXY was like 35, 36, because it seemed very far away. But now 31.62, that's pretty close to the 30 strike. So this thing does have a chance. As we watch right now, I did this today and it screwed my, thanks bro. As we talk right now, UVXY has moved a little bit lower. So just the last update before we leave, to sum it up, we are long the 37.27 put spread in UVXY. Our current Greeks are we are short 330 deltas. The position has made money the last couple days, which is great. I'm not afraid to mention that we made money because I was very public about us losing money before. So now we can be public about making money. So positions making money, continue to stay short volatility. I think there's a potential that this, it's going to, you have to agree with me on this. UVXY will take out the all-time low again sometime. We don't know when that is. If we look at the chart here, we can see the recent spike, and we can see it coming down from there. It's got to get to here for us to have maximum profitability. I think for us to break even, it has to get to like here, maybe 28 something. But that's where we stand. That was a huge spike, a huge opportunity. You did have people in StockTwits and stuff when this was like 36.50 saying like, oh, this is a great buy up here. It's a good buy your wallet. Now, it could have moved higher, but mostly when we have a spike, it only lasts a day or two and comes back down, right? If we look back over time, that seems to be the case, right? So when we're in a spike next time, don't get too caught up in the hoopla of everybody, because if you look at chat rooms or StockTwits or something, when we're spiking, every single person is going to be saying, got to get long this. You're an idiot if you didn't get long this. I made so much money being long this, et cetera, et cetera. So you have to turn off that noise, focus in, and do your own thing. Because trading is an internal thing. It happens between you and your mind. You can have friends you can have friends who trade and stuff like that, but in the end, it's a battle of you internally, really. And it's a skill of being able to look inside yourself and pay attention to the various indicators that you have, that all this stimulus that's coming at you from all angles. All right, so my question is, what should we do next with this position? Should we just close it and say, thank goodness the money came back? Should we ride it out? Should we, and if this does get to 27 tomorrow, should we just close the position out, or should we sell out of the money put spreads and turn this into a condor? Those and many other questions will be answered next time on the Short Vol Show. Thanks for watching, folks. Have a great weekend, and we will see you soon.